All right, guys, welcome to the Apartment Educators Monthly Meeting. My name is Devin Elder. Tonight's topic is how to get your first deal done. So we've got some great content to share with you guys. We're going to dive in here in just a moment. I will say you've got the ability to do Q&A. So there should be a box on your screen somewhere to enter questions. And if questions enter your mind at any time, just punch them in there. And then we're going to spend some time at the end of the presentation answering those questions, right? So just type them into that Q&A throughout the presentation, and we'll save some time for sure for Q&A at the end here. So we're excited to be able to deliver this from the comfort of your own home. Obviously, like the network, we're not going to be doing that this month. And this mobile broadcast here gives us capability for lots more people to join safely. And so we're excited about this capability. So let's dive in. How to get your first deal done. I'm one of your hosts, Devin Elder. Mr. Abel Pacheco is on as well. And I'll turn it over to him to kind of talk about the vision for this meeting.
Yeah, everyone. So we originally started this multifamily meetup about 10 months ago, maybe a little less than a year ago. And ultimately, we really wanted to have an opportunity for us to bring the multifamily investing community, whether you're a general partner, syndicator, whether you're a passive investor, or just really new, trying to learn more about the multifamily investing side. We wanted to create that opportunity. So that's what, that's how we started, really just providing education for some of our investors, education for the group. And, we wanted to, create that networking also. So we'll figure that part out, if we're in this state long term. But we have these monthly, and they've grown from, 5-10 people, I think, on our first one to, our last live was probably 50 to 70 people. Well, 70 people at one of the largest in 50-55. And so God willing, we'll get back to some kind of normalcy in the state. But until then, this is a great opportunity for us to keep our community moving forward. We think it's important for us, our economy, our families, just, everyday American lifestyle is not about, just hunkering down and staying put. So during these times, we're trying to think about how to innovate, how to move forward, and how to progress, our team and our community. And so this was the best way for us to do it. So we're excited to have all of the people outside of San Antonio now in our meetup as well.
Awesome. Yeah. So we want to provide education, networking, and then we're going to be doing these on a monthly basis. So quick word on our sponsor, Apartment Educators. You see here in the photo, this is one of our pictures from our last events, and these are all Apartment Educators students, and myself and my co-founder Ruben, and Abel's in there. So what we do is we provide education for teaching people how to purchase, operate, and exit apartment buildings, full cycle, the whole thing. We basically show you our business model after having bought thousands of doors and gone through that for years and years, share that with you and teach you how to do it. We think mentorship is extremely important when you're getting started. So there's an education component, but then there's also an ecosystem, right? You're going to need the team, you're going to need vendors, you're going to need partners, and we want to put that all together and tie it up in a bow for somebody that's new to investing in apartments to be able to come in, consume that, learn, and get everything they need with that ecosystem. We have small cohorts of coaching students. We're accepting applications now for the next one. If you have interest there, you can go to apartmenteducators.com and fill out the contact form, or you can directly email my partner, Ruben, at apartmenteducators.com. And I want to say we've got students here tonight. Normally I would point around the room and introduce some people. We're doing this virtually, so they're on the call, but not actually going to go around here and introduce people. But definitely that's part of the normal kind of monthly cadence. Abel, one of the coaches here for Apartment Educators. I don't know if I missed anything there. If you want to fill in any gaps on that.
No, if I can speak for the students, because I was a student myself. So I think one of the greatest opportunities, in these deals, when you're jumping into a large real estate acquisition that's 7, 10, 15, 20,000, $20 million plus, it's good to have a network of like-minded individuals that all, are driving towards the same. So I was a student, been to a few different programs. If you want to ping me about it afterwards, I think Apartment Educators is, literally one of the best, if not the best in our community, because of the sponsorship, the networking side, and, who we are and what we do, especially if you're interested in San Antonio, Texas, or Texas as a market. So, was a student and have had success with program education, mentoring, and now, doing deals as well. So happy and excited to be a coach for the program as well. So yeah, it's great program. Thank you to our
Very
sponsor.
good. Very good. So a little bit about myself here. My name is Devin Elder, one of the co-founders. I grew up in San Antonio. I spent a decade in the corporate world working for two of the largest employers in San Antonio, and then got into real estate investing about almost a decade ago, and since then have done over $100 million in transactions on the multifamily side, so thousands of units, and that allowed me to leave my corporate job and really kind of build the life that I dreamed of, that I wasn't able to do as an employee, right? So that's been a life changer for me. Why am I here tonight, taking time away from my family with you guys? There's a couple of reasons, but we're growing Apartment Educators, but I know that the likelihood is very high that there's somebody on this call that I'm going to partner with or do a deal with at some point. Maybe they invest in one of my deals. Maybe I partner with them on a deal, but frankly, there's a lot of money in these deals. And so building relationships and networking and partnerships is a huge part of what we do. And that's the reason I'm here. I also do like to teach, for sure. And I enjoy kind of that aspect of it. But frankly, there's somebody here tonight that I'll probably do a deal with in the not too distant future, and that'll make us both a lot of money. And that's definitely a component of why I'm here.
All right. And again, Abel Pacheco. So I'm with Five Talents Commercial Real Estate. And, a little bit of my background. I am originally from Corpus Christi, Texas, grew up there, and now I live in San Antonio. 40, so I spent half of my life in Corpus and half of my life in San Antonio. I was in the professional world for good number of years. Rackspace, if anybody's familiar with the IT hosting company, I had one string of success from 2010 to 2016. Grew the acquisitions business from 5 million to 57 million in about a 6-year time period. So that's where I came from. I've been investing since 2008. And we are in about 800 doors invested in. So 4 apartment complexes, a couple as a general partner, a couple as a limited partner, and then about to break ground probably in the next month or so on a new development as well. So I'm excited for that. And that's a little bit of me, my background. I would say why I'm here. It was if anybody knows me from my professional world, or if you want some references, let me know. I have a few, but they know I love serving others. I've always been just that individual that likes giving back. I've had a lot of success over my careers because the people on my team have always pushed me up to have success with them. So big proponent of helping others, of serving others. I'm a servant leader at my church as well. And so it's just part of who I am. So I've found a lot of success in the professional world, and that's basically what I'm doing, is leveraging that same mentality or mindset to this world. And it served me very well on both sides. And then the opportunity, of course, to network with other investors, with other individuals doing deals. You'll find pretty quickly, even as we go through this presentation, that this is a team sport. So whenever you have the opportunity to come together and network and learn from and grab some education from other like-minded individuals, that helps a lot. And doing this in our backyards here in San Antonio, Texas, is also great. So now some of you from your house is also great from the internet, because if you ask Devin how many cities he's been to, for boot camps and multifamily conferences. And, this just an effort to try to get around other people that are doing this. I think that's a big part of it. And if we can do that here, whether it's locally in San Antonio or now, on the internet with other like-minded individuals on a monthly basis, I think it's a big part of what we're doing in my wise. So nice to meet everyone.
Awesome. Awesome. Why multifamily? So there's lots of different investment options. I'm not going to list them all, but there's lots of different things to do. And then there's real estate, which we love for appreciation, depreciation, cash flow, tax advantages, all that good stuff. But multifamily specifically kind of presents an opportunity that's really special among all of the investment options. And this is a little picture here of a project we bought in San Antonio last year, 68 property. It's really well. We love that property. In fact, that property makes me want to buy more clean, nice properties because it's been a cakewalk compared to some of the other more challenging deals we've done. But why multifamily? We're looking for good returns. We're looking for a passive investment that we don't actually have to go work in. We're looking for tax benefits, and we're looking for safety, right? So those are the primary reasons that we want to invest in multifamily. Why now? This is a special time to invest. Abel, if you kind of want to touch maybe on this slide here and cover that.
Yeah, I think really the why multifamily, why now kind of leads very well together. One of the first ones, if you haven't been watching, the Fed cut interest rates to zero. Even before that occurred, knowing that there is an opportunity for us to buy a larger asset than we would have been able to buy as an individual, like single family, which most of the time you're buying on your own. When you jump into multifamily, it very much becomes that team sport. So the new legislation that occurred is, in 2012, the Obama passed what's called the Jobs Act. And that Jobs Act was literally meant to jumpstart new businesses, increase the amount of private capital in the free market and in our market, so that we could pull money together and go work together on one of the avenues to do this is through a private placement or a syndication. So in 2012, when they passed that gave all of us the opportunity to start a new business, raise capital, pull our money together, create that syndication, and instead of having to register that as a security with the SEC, they gave some new exemptions. And that exemption was a 506B and a 506C exemption, basically saying, hey, if you were an accredited investor, you can pull your money in together on an opportunity. The sponsors or managers of the deal can advertise, and that was one great way. And if you were not accredited, well, that was still a great way to get in. And that's knowing an individual that's working in the business and doing these deals, and they give us 35 spots for non-accredited, sophisticated investors to get in. Prior to that, it was you had to really know somebody to get in, and so that new legislation spurred our economy to create more capital in the marketplace. And coming back to the Fed cutting rates to zero, that does not mean the mortgage companies are going to lend at zero. What it means is banks can go to the Fed and take an overnight loan from them at a 0% interest rate. So that capital that's coming into the market, especially moving forward, should be readily available, great for projects like us. And then that's one of the probably the best times in our 50-year history. I don't think there's ever been lower interest rates than in right now, the 50 years. So if there was ever a time to buy income generating asset leveraging, now's a good time. And then, really the millennials, as you start to get, weed through the 2008 kind of recession. And then now the thought process or the reason why is millennials are now moving towards multifamily more than ever. You have an amazing community style living, and it's affordable. There's very little affordable housing that's going to have a pool, that's going to have a gym, that's going to have a really nice community feel, outside, living, barbecue pits, and that type of thing for a reasonable, affordable rent. And then, my mom, even tapped me on the shoulder a couple months ago. She said, "Mijo, when I get time to sell my house, can you help me? Because I kind of want to live in one of those communities with people, like me, the senior communities." And so that multifamily is becoming more and more prevalent in today's day and age. And today with the technology and social media, kind of really coming back to the fact that investors like me and you, I'm just a normal guy. I don't have $10 million to purchase an apartment complex on my own. I've got to work together and partner with other individuals that we can all build a team. Well, according to some of those exemptions for 506B, Regulation D 506B that the SEC gives us, we have to have a pre-existing relationship and we have to know each other. So that nowadays in social media, the fact that I have somebody on a friend doesn't mean I have an existing relationship, but it does mean that I can connect with somebody in New York or California or Denver and meet them and continue building a relationship where I know their goals, they know my goals, and we're eventually having a conversation, and they potentially invest with me or vice versa. That has shrunk the distance, or it's made it so much easier for us to kind of work together, partner, no matter where we are in the world, and potentially do deals together as investors. And that all of those things really spur to multifamily. Part of that's why these are prevalent now more than ever, among other things. Did I leave anything out, Devin?
No, I think it's really good, really good. So a lot of capital to do these deals, a shift towards renting. For many reasons, we're becoming a nation of renters, and then technology and social media are facilitating easier connections and ability to get these deals done. I love it. Great overview. So the topic for tonight, we're going to talk about getting your first deal done, and what we're going to cover tonight is who buys big apartment buildings. We're talking 5, 10, $20 million buildings. How much capital do I need? That's a big one for people coming in, maybe new. I mean, how do I go buy this building? Building a team, we're going to cover that, and then finding a deal. So those are 4 critical components that we're going to cover to getting your first deal done. So first off, who buys these buildings? If you look around, you drive around in any major metro in America, you're going to see a lot of apartment buildings like this one right here in the photo, which is one of our apartment buildings, which really looks beautiful. This building was bought by a group of people. So I led this deal, and we have investors in this deal. Some of them at $50,000, some of them with more. But it's a group of investors that we go out and purchase this building together. And that's the way we overcome any challenge in multifamily investing. Is any gap you have, whether it's capital, knowledge, team, et cetera, you can bring in a partner or vendor and get the thing done. And I stress that all the time. Any gap you have that you think, oh, I can't do this because X, well, a partner can do X or a vendor can do X, right? So that's who buys these things a lot of times is a syndication or a partnership going out and buying it. And there's a lot of reasons that that's preferable to say each individual investor going out and buying their own rental house, right? There's more money in these private placements than there is in the stock market, which is just a mind-blowing fact, right? So the wealthy have been doing this for forever, right? Is buying these big, safe assets and profiting from them. Now it's gotten easier in recent years to put a team together and go buy this. There's private equity companies, these big multi-billion-dollar companies out of New York City or whatever, that go out and play in the same space. Usually they're typically buying some bigger stuff, but that's who's buying these projects as well. And then you've got REITs, real estate investment trusts, and other institutions. So you might have a big insurance company that says, hey, we have $10 million we need to put into a project. And so that's really who's buying these things. Regular folks like us, like me and Abel on this call, private equity firms, and then other institutions that want to buy these things. Anything I leave out on that, Abel?
Yeah, before you move on. So coming back to 2012, that Jobs Act that changed, on the regular people side of it, one of the other things that they changed was if prior to, then, if you were an accredited investor, if you take the time now to Google that, you'll find an accredited investor can jump into more of these opportunities. Today, they're $1 million net worth, 200K of W-2 income, or 300K as a couple. That's an or, so one of those qualifies you. But prior to that, the old accreditation was $3 million, and there was no exemption for the 35 non-accredited investors prior to 2012. So it was much harder to find these opportunities, and then you had to have that accreditation, or you weren't even one of the 35 people that was kind of like the friends and family in the deal. So that's why. So today, that regular people button is, or the bullet in the front, and that's regular people. Everybody just like you and me that make a good income. We're trying to figure out how to invest. And prior to this 2012, we wouldn't even have the opportunity to jump in unless you were a higher accreditation. So which is just a great opportunity in today's market, which is spurring the economy exactly what they want us to do. So we buy them. Yeah.
Yeah, I love it. I mean, this is what wealthy people have been doing forever. So
Yeah.
we want to invest like the wealthy do.
Yeah. And Devin, let me, if you can, maybe I can start this one and then finish me off.
For sure. Love it.
You can definitely hit all the finer details. So on this one, for what do I need, right? Well, there's an apartment building that we're trying to buy. So there is the opportunities to look at, to underwrite, to analyze, to walk through, to make an offer, and to try to find one. And Devin, you can vouch. I think you guys looked for 6 or 7 months before a deal, or in the last deal came up, and you're probably underwriting and walking 2, 3, a week, if not, a ton more a month. But the deal is so hard to find. If anybody's in single family real estate investing on this call, that the math or the numbers equate to having to look at 20, 30, 50, 100 properties if you're trying to find a deal at 65% ARV, or 50% of ARV if you want to turn it around and flip it. Well, that is one thing that's the same in multifamily. It's really sifting through all of the deals to find the one that really pencils out. The experience side of it, it's you don't want to just jump into a $10 million acquisition. If you've never done this before, even if you have the money to do it all on your own, you really want to ensure success. You want to ensure that it's run properly and that you can reasonably come out of the other end of the deal with the returns that you were expecting. So that experience, as Devin mentioned earlier, is being able to leverage the right people on the opportunity, whether it's property managers, whether it's asset managers, maybe it's underwriters, capital, trying to figure out who has the net worth and liquidity to fulfill some of these loan requirements. At a simplest term, if you had a $10 million building, you need net worth on the guarantor side, on the general partner side, to be equal to the price of the asset you're buying. So if it's 10 million, you need a general partner team with $10 million of net worth, and they generally ask for 10% of liquidity. So $1 million cash. And if you don't have $10 million net worth and you're not $1 million liquid, that's not invested in the deal, then you're trying to figure out the team, which is what, we'll go down to this a little bit finer, but that's what you're looking for: the deal, the right experience, the capital. The lenders would typically, rule of thumb, 80% of the loan, just like in a single family investment property is 100,000. They want 80 for the loan, they want 20K down and they'll lend you 80%. Same thing. If it was a $10 million building, they would want $2 million in the loan. 8 million is what you're going to leverage. And then if you have $1 million of improvements, you need to raise that too. So that's kind of like the overall general picture. And I know we've got some slides that kind of dig in a little further, but Devin, is that a good overview of what we need?
Yeah, that's really it. I mean, you can think about how much is the building you're buying, and then the loan is probably 75% of that, just rule of thumb. So that loan amount, the team's got to have the net worth for the loan amount. And if you don't have it, you bring on somebody. And so if you have this much net worth, your partner has this much net worth, together, you've got all of it. And so, what I've seen over and over again over the years is, somebody has more money and they don't want to work, and somebody's got less money and they want to go do the work. And that's a great partnership, because the person with the money, I don't really want to go run it. I've already made my money, another business or other real estate or whatever, but I'll partner with you on this deal. You give me a piece of the deal. I don't have to do anything. I'm taking little risk, but that's kind of a nice deal for that higher net worth person. And then the person that's earlier in their career wants to go operate a deal. Hey, that's great. Now you can put together the net worth of the team. So that's a very common structure. And don't get bent out of shape if you don't have $10 million net worth, because these partnerships come together, and that's part of why we're doing Apartment Educators, is to build these partnerships for everybody.
Out of all these, Devin, what would you say is the hardest to get?
Well, experience, right? Because that takes years. So what you're going to do if you don't have the experience is you're going to borrow credibility, and you're going to partner with somebody that does have the experience. And on your first deal, are you going to keep all of it? No, you're not. Your first deal is about getting a deal done, putting a win up on the board, getting a good deal done, not just any deal. I mean, we could all go close a deal tomorrow if we didn't care about the numbers, right? But you want to borrow somebody else's experience. It's one of those things, if that's your gap, you can partner with somebody, and then together you play the we game, you have the experience. So I would say that's the hardest one, because that takes years to go get that experience where you can stand on your own and do it. And until then, you just partner with people.
I'll ask you another question too. So how does one find a deal? How do you find a deal, Devin?
The simple answer is brokers. Now, I think there's some opportunity in, call it, the 10 to 20, 30 unit space. If you're looking for a smaller apartment where you might be able to find an owner, maybe they've had it 20 years and they haven't improved it, or they haven't raised rents like they should be doing every year. And there could be an opportunity there, just dealing directly. But you start getting into larger properties, which we kind of advocate for a lot of reasons. You're going to go through brokers almost all the time. In fact, it's so heavily weighted to going through brokers that we've just said, we just go through brokers. We're not going to try to call a million owners and that kind of thing, right? We're just going to leverage our broker relationships, let them do all the work, and try to be the best buyers that they've ever worked with. Great question.
Yeah, and I'll qualify too. We probably should have done this earlier, but in case you didn't know us or the community, and you're joining us for the first time, we look at 100+ unit apartment complexes in the multifamily space. So Devin said 10, 20, 30. Some of the reason we don't syndicate those or put those together, it's very hard for us to make the numbers work when you're looking for acquiring them and allotting for professional property management, professional asset management, professional construction management. So that's kind of typically why we set our sites higher. Will there be an 85 unit potentially at a lower price that might work? Maybe, but definitely looking for the larger projects.
Yeah, you get some economies of scale doing that. And if you're going to go through the work of a real estate transaction, it's better to do bigger if you can. And again, you might need to partner with somebody to facilitate that, especially right out of the gate. But they tend to get a little bit easier when they're bigger. That's maybe an axiom that you've heard, but it's true. It's kind of funny.
And moving to the next slide. So what if I don't have $10 million? I don't have $10 million. I don't have $1 million net worth. I've never managed a 268 unit, apartment complex. What if I'm missing something?
Partner or vendor. It's building the team. I mean, that's really the name of the game. And so great question. I mean, I think we can talk about the components of going to get a deal done. And if you're missing something, you partner with somebody. Like I mentioned, let's say we're buying a $10 million building and the loan's $7.5 million. Well, the lender's going to want to say, hey, who's on the management team that y'all need to have $7.5 million net worth? And if you go, well, my net worth's 500,000 with all my cash and, any real estate I own, investments, the whole thing. So I'm 7 million short. Well, you can bring on that person that's got that $7 million net worth, partner with you, and now together you got that $7.5 million net worth. And what's funny about real estate is your net worth stacks up crazy fast, right? You start buying apartments and it's not uncommon to start adding $1 million or millions of dollars to your balance sheet. You do a couple of those a year and, you know, on paper, you can be a multi-millionaire very quickly. Now, the difference is, you know, between what it's worth and what you owe and how much of the equity you own. You know, I don't like to put a lot of stock in net worth, right? Because it can go up, it can go down. But I'm just talking about for the bank's purposes. That's what the bank wants to see. And so every apartment complex I buy adds millions of dollars to my net worth, right? And so we can just keep stacking those. Now, if we go sell it all tomorrow, is that the exact dollar amount I'm going to get? Absolutely not. Just like a house, right? If your house is worth 300K and your loan is 200, well, you have $100,000 net worth in that house, right? It's pretty good. If you go sell the house, are you going to get a check for 100,000? Absolutely not, right? You got commissions, fees, maybe a price reduction, maybe some repairs. You know, it might look closer to $80,000 by the time it's said and done. But that's not what we're talking about here, right? So for you personally, for your own personal finances, you want to understand net worth's not real in terms of the cash value today of it. But in terms of what the lender wants to see, it's really, real estate is a fantastic way to stack up net worth very quickly, right? And then once you do that for a few years, now you can be somebody's key principal. So this is kind of the second thing here, key principal. That a lot of times that's the term used to describe the person that has that big net worth, right? So maybe you partner with somebody that's bought several apartment buildings. They have that $7 million net worth, and you're just coming in and they'll partner with you. So that the key principal helps you get your net worth requirements there for the lender. Risk capital partner. So it's kind of like a house. If you buy a $10 million building, you might be putting down 1% earnest money, just like a house. You might put down 1% earnest money on a house that you buy, except instead of putting down $10,000, $5,000, you're putting down $100,000. If you don't have $100,000 cash to put in the deal, you can find somebody that will partner with you to front that 100,000 just for the 60 days it takes you to close, and they're going to get some equity. And for the right person that's got some lazy cash or some extra cash and they're in the apartment investing game, maybe they're in apartment educators and they understand how this stuff works, that's a pretty good deal for them because they're going to get equity in a deal that's going to be worth a lot. And all they have to do is put some capital up for a short period of time to get the deal closed. So that's a great way if you're doing a deal and you don't have the $100,000 to give to title up front. Well, somebody can step in and partner that does have some extra cash, and they understand that they're going to get some equity in this deal and get the deal done. Next one is experience, and I mentioned that's the hardest one. Your first deal, you're not going to do you're going to borrow experience. Yep.
Let me, if you don't mind, maybe I can talk about experience and track record because I have less of it. And somebody on
relative, but
was
right.
like, you know, they're trying to figure out, well, how do I get it? You know, the experience. So hardest thing to get experience. And if you're not a Devin, how do you get it? So that was me a couple of years ago, and I'm trying to build up, you know, my track record and experience. Devin has said it a couple times, and this is part of, you know, the entire, you know, our point today, our education is, how do I get my first deal done? Well, if experience is the hardest, then borrow someone else's. And a way to do that, one of the best, simplest, most easy way, and this is the way I did it, so this is not the only way, but I invested passively with somebody else. I invested money that I took out from the stock market. I put it, I left my W-2 job, which I had some 401k. I put it in a self-directed IRA without any penalties or any kind of early withdrawal or any kind of fees. And I moved it over and I directed it into my first apartment complex. And that allowed me to literally say, according to the IRS, according to the K-1, according to my track record, I'm partnered with a team that has X amount of track record. So they've done 5 deals, 7 deals, 10 deals, and they've done that. So really what happened was I took that experience and, you know, number one, got to borrow it because that's what I was doing, but also learn through the process. The experience of just being a passive investor, if you're trying to go syndicate a deal, you're going to have to raise capital from private investors. And one of the things they're going to ask you about is, have you done this before yourself? Have you invested passively? Have you gone through this? And if your answer is no all the way through, I can tell you that it's going to be pretty difficult raising a few bucks. If you can say, I've done this once, twice, 3 times, my wife is in hers as well, it leads to that experience, because I can literally say I have invested passively in 400 doors and, you know, however many millions of, I don't know, $28 million of real estate, because that's who I am, and that's what I was doing. And I was able to speak through it. So now as I'm working with investors, they want to know, have you done that? And I can say, yeah, this is how I did it. And this is how I got my first, second, third deal. And then as you're gaining momentum, you can work with the team. It's your money, put it where you want to put it. So if you want to try to be a general partner and lead a deal, you know, talk to your sponsors, talk to the management team, ask them if you can, you know, learn, and you'll realize, oh, you get monthly reports. You look through the P&L, you look through the profit and loss, the business plan. You get to see your rent rolls on a monthly or quarterly basis, and you're learning through the deal. Now, when it comes time to you doing that deal, you can use that experience as a passive investor and share with others. Most of them are going to ask you, how did you get in? And then now you can say, look, this is how I did it. That builds your track record as a passive investor. And that leads to more success when you're finally ready to go jump into the operator or general partner, managing member side of the house. You're borrowing that track record. You've been there, you've done it, you've had the experience, and you may not be leading the deal, but that you're getting a small piece of a bigger pie. And now you're on the general partner side, and you start to learn more through every transaction, every deal that you do, and it quickly becomes your track record. And now that's what you're explaining to other partners, other team members, other investors, and it really builds on itself. So again, not the only way, but that was one way that worked relatively quickly. I went from 8 doors to 800 in a matter of like 2 years. So.
Yeah, that's one of the reasons we love this business, for sure. And a lot of it, like, let's say you start a new job, there's going to be new acronyms, new players, new kind of everything. So you want to get in the game and start learning that stuff. And it's not rocket science what we're doing. I mean, it's really not. But there's stuff to learn. There's a certain nomenclature and there's certain players, and you want to kind of dip your toe in the water and get familiar with that stuff before you start going to do your own stuff. So that's a great way to get started there. Okay, so the takeaway, again, I'm just going to beat it to death. If you're missing something, any component, partner or vendor can get you there, right? How to find a team. Well, you're doing it right now, right? This is one of the reasons we do this. So there's meetups, there's networking, seminars, a coaching group like Apartment Educators. Those are some of the ways to build a team. And you're going to want to just create a spreadsheet, or maybe you're a little more advanced. You have a CRM, customer relationship management software. Just start putting that stuff together. Hey, who could be my key principal? Who could be, my insurance guy on the deal? Who could be coach if I'm new to start, get me started in this business, right? And just kind of start trying to build the players that are going to be on that team. We kind of want to start that pretty early on so that you can start building those relationships, because when the time comes to do a deal, things will move pretty quick. Abel, what did I miss there?
Before I move, I see a question that went unanswered, so sorry. Key principal and sponsor, are they the same? So as we're talking about the team members, like Devin said, I'm looking for a key principal or the person who has the net worth or liquidity, or maybe two, to kind of team up together. And I am literally trying to go find those individuals and shaking hands, or Corona bumping, or however you want to do it right now. The technology side of it, the social media side of it. I'm putting my goals out there, and I'm looking for others who have the like goal that want to team up with me. They know, hey, you've got the grit, you've got the hunger, you got the desire to go get the deal, find the deal, run the deal, make it happen. Well, I have money and I'm a liquidity partner and I'm a KP, which is key principal. So to answer the question, and then the question, the second part is, is the word sponsor on the team? So the words are synonymous, whether they're key principal is one specific role, but let's say a general partner, a manager, uh, a GP, a sponsor, a co-sponsor. They're all basically alluding to the people on the management team that are helping operate the deal. So you're trying to figure those roles out. So say finding a team, you want to network, you want to get out there. Uh, the coaching groups, seminars, real estate seminars. I'll tell you on this stuff. I probably joined about 6 or 7, I don't know how many programs, real estate programs in a couple of years, and I went to about 15, cities at least, and I've gone through about 240 plus hours of like education in some form, fashion, and not including podcasts, right? Just sitting in front of, taking notes, things like really these conferences and boot camps. And so that was like a super fast forward button, as is a coaching group, is a fast forward button to go find all these things. I didn't know before 2 years like the word key principal, or that there was people that can sign on a non-recourse loan and that are willing to do that for percentage of a pie. And now, I know a good number of those individuals, and I have them, listed in this part of my network. And then I know, there are individuals that are in the deal flow in their market. We're focused on San Antonio, Texas, on Corpus Christi, Texas, for me, where I'm from. And, New Mexico is one of my first jumps outside of Texas, but there are syndicators and operators in any area of the world, and they're focused in that specific spot. So if you ever wanted to go jump in a deal or move to a new city, that there are individuals that are already there. So I think that's a big part of this, is being in the group, in the club. It's not a country club type of environment where you can't get in. It's private, it's closed, it's very open. This is an opportunity where you can go extend a virtual handshake right now, meet somebody, tell them your goals, tell them what you want to go do. And if you can join a group, I would say, again, fast forward button, which is, Apartment Educators is a fast forward button for me, as were a few other programs as well.
Awesome. So that's kind of the highlight on how to find your team. We're going to wrap up and take some Q&A, which I'm excited about. Real quick, we're doing our next meeting a month from now, roughly April 21st at 6:30 p.m. We're going to cover how apartment investors get paid. That's one of the big reasons we're doing this stuff. There's lots of awesome ways apartment investors get paid. So we're going to cover that in detail. I would urge you to like our Facebook page, Apartment Educators, so you can see the events that we're doing. And you can also go to, obviously, the website, apartmenteducators.com. Reach out. If you have interest in applying for our coaching cohort that's coming up, you can do that through the website, apartmenteducators.com. I think I'm going to leave that up while we do some Q&A. I'll leave this slide up. So put that on your calendar, April 21st, next month. And let's kind of jump into some Q&A. I think
I've got one from Kay Wilson. It's what is the application for? And I think that I think it was referencing the Apartment Educators program, and that we are, I'll speak on the coach side. We have a small group, about 5 of us, that are on a second cohort, and a lot of people want to hit that fast forward button. And if basically we're taking applications, we've got a lot of things going on personally, family, and business. We can't really spend all of our hours coaching. It's not, primarily the thing. However, there's enough demand for it. Every, whatever period of time, we can say, yes, let's start a new cohort and meet with a small group for, 6 weeks or 8 weeks, whatever. then essentially what we're doing is taking applications, and if you want to join, whether it's 3 months or 6 months from now, we take those applications and then go back to the people that have applied, and then those are like basically the first come first serve. Hey, we're launching a cohort. Is it something you want to join now? So I think Kay Wilson, I think that's what you were asking, what the application's for.
Awesome. So we got a question here. What is your criteria when looking at deals? There's a lot that goes into that, but essentially we're looking for about a 15% IRR or better. IRR's internal rate of return, or maybe a 16 or 17% annualized return. So you think about it like if you're in the deal for 3 years and it makes you 60% of your money, right? So you put 100K in and you get 160 back. You made 60% on your money in 3 years. That's 20% a year. We're shooting for deals that are going to return that 16, call it 16, 17, 18, 20% annualized return range. And then what we'd like to see is deals that can cash flow while we're holding it. Let's say we're in it for 2, 3, 4, 5 years. We want to be able to send out distributions at, let's say, 7% annualized return. If you got 100K in the deal, we want to be sending you 7,000 a year, 8,000 a year while we own it. And at the end, when we sell, we want to return all your initial principal plus your gains plus your cash flow. All that adds up to, call it 16, 18% annualized return. So that's what we're looking for. And then while we're holding it, we're getting paper losses. So, it's not uncommon to have $50,000 invested in a deal. It sends you cash flow, and you got a big paper loss for the year. So that's kind of one of the advantages that we look for. But short answer on that is, hey, if we can get investors, and that's net to investors, right? Net everything in their bank account. 17% annualized, that's really like one of the best investments you're going to find that's not super risky. I mean, you might beat that return getting lucky on something, but to do it consistently at even 15% return is really attractive, which is why we do these deals. So to get those returns, we're usually looking for 70s and 80s buildings where we can go in and do some kind of improvements and see cash flow on that over time. It's a great question, though.
To add, Devin, so kind of the target being a Class B or Class C. If you don't really know the lingo, right? There's different qualifications. There's a Class A, or there's probably luxury, Class A, Class B, and Class C. And that kind of speaks to the years of the building. So, 30, 40 years old, maybe in a rough neighborhood, maybe a kind of a war zone kind of area. A D, C property, maybe, 20, 30 years or a little bit more, but in a decent neighborhood, but needs a little bit of CapEx, some interior improvements. You may have a C in a B neighborhood, and that B neighborhood is, one of them, A, B on Brook. So it's, C-ish nice building, but in a great neighborhood across the street from a great high school, B neighborhood. And then, the one that you had on the picture, call it a B plus or an A, however you want to call it. It has some mix of 1980s building and a mix of new build, right? And then the part of it is like the conservative underwriting, being able to, no matter where the asset falls in that class, Devin saying, hey, I want to give those returns to investors. You've got to underwrite it conservative enough to where you can have some, sensitivity, analysis, some risk assessment that says, hey, I've stress tested this thing, it can, kind of withhold and produce the revenues that we're looking for, which, turn into passive investor money.
Love it. Love it. Did we get to everything in the Q&A box, Abel?
I think I see a couple more. Hold on, let me see.
Okay.
Yep. For Mr. Dwight. Hey, Dwight, how's it going, man? What happens to the deals that you or other syndicators do not opt for? Who ends up buying those? Trying to understand what happens to the bad deals. Does negotiation turn a bad deal to a good one? So a few questions here. Let's take them one at a time. What happens to the deals that you or other syndicators don't opt for? We decide not to do it. We pass.
Yeah, but every deal's different, right? And there may be a deal that didn't work for somebody, and then the seller changes or they get desperate and it works for somebody else down the line. So I mean, these things are very fluid. It's not like a commodity that just trades at a certain price. I mean, everything's kind of a negotiation. So also you've got different buyer profiles. So a deal might not work for me because I'm looking for a certain thing. It might work for somebody else, right? So I mean, every deal is different, and you know, there's a lot of variety there in terms of what people are looking for. Obviously, people want to buy at the right price and everything, but a lot of times in the multifamily world, people are looking to place capital too, you know, so they got money to place, and they may accept a lower return in exchange for all the other benefits that multifamily is giving them in terms of appreciation, depreciation, cash flow, and all these things that happen. So you've got different criteria for different folks, kind of based on the buyer out there.
And I'll to add on to it, it's you know, if we're buying it to syndicate it and return 2x our capital to investors, then we've got to underwrite it conservatively enough to turn that, you know, that the capital raised to 2x. If a cash buyer or someone who can do that on their own without syndicating it, you know, can acquire the property without having to pay an investor back, they can technically afford to pay a little bit more than maybe somebody else because they don't have any investors to pay back. So, you know, that potentially could be somebody that ends up buying, or, you know, like Devin said, maybe somebody overpays and they were excited to get into it. But then the last question here, does negotiation turn a bad deal into a good one? Maybe you can talk about what would be good retrading and how it's good not to, and, you know, building a good relationship with the broker and LOI process. You want to come out the gate with an offer, stick to it, that kind of thing.
Yeah, so a negotiation can turn a bad deal into a good one. Absolutely. I mean, at some price, at some point, like any deal kind of makes sense at the right price. So for sure, that could happen. There's a lot that goes into the negotiations, right? But again, we're kind of like, we look at one metric. What's the investor return we feel really good about being able to hit, and that kind of drives all the underwriting and the negotiation. You know, is driven by what we can hit for investors. Another question here, for someone who is interested in passive investing, in order to gain the experience and track record, would they just need cash in order to invest with a team? Short answer, yes. You know, you just need, and you can use IRA funds, you can use retirement funds, you can use cash. You may or may not need to be an accredited investor, means you have a certain income or net worth, but that's not always required. But you're probably going to need a pre-existing relationship in some cases with a team, and that's what we're doing here, right? That's why we do these events, so people can network and get to meet each other and invest. But yeah, essentially, as a passive investor, you need to find somebody that has a deal, feel good about partnering with them, and then literally just write the check. I mean, there's more nuance to it, but that's the benefit of being a passive investor. That's why I like being a passive investor in addition to running our own deals, is, hey, I can have 50K over here parked with this guy, and I can totally forget about it. Maybe I read some of the emails sometimes. I get distribution checks that I have to go cash, you know, but there's nothing to be done beyond that. So if you look at a typical deal, like most of the investors, 70% of the capital is passive investors that are like, hey, you go do the work, right? And then the person that does all the work, the sponsor, yeah, it's a lot of work, but there's a lot of money in it too. And that's what we'll be covering on next month's topic, is how everybody gets paid. But short answer, yeah, to be in a deal, you basically just invest passively.
That was Preston Shea. Mr. K. Wilson, could I possibly partner with y'all? Would it be a good time to invest since the interest rates are low, but knowing coronavirus is out there, how do I go about that? It'd be a good time to invest since interest rates are low. Yeah. So on the interest rate side, maybe I'll hit that one too again. The Fed cut that interest rates. The 10-year treasury bond, the 30-year T-bond, those things are like 50-year record lows. What I've seen so far and heard from some of the loan brokers is that there's a mad rush, a bunch of residential consumer debt, people going to go refinance their houses. It's literally caused the way they describe it, a traffic jam, like on the highway. They can't keep up with the amount of refinances that are happening right now. So actually last week, interest rates kind of spiked up a tick, slightly. in the consumer product area. So as that happened, you fast forward after the traffic jam, after the initial rush goes through, then you're probably going to have that open up period where people are trying to figure out how to capitalize on the low interest rates, which is exact intent of the Fed to spur that in the economy. And so 2 weeks goes by, 3 months goes by, the time we'll start to, we'll start to see how aggressive the lenders get with low interest rates, and that could yield a great return for us. So, and then the coronavirus, maybe I'll start, Devin, and then any thoughts, man, around it, dude? It's
Yeah.
shoot, I mean, there's a time where I think we're in an uncharted territories is a good term that I've heard. So that uncharted territories, I mean, you gotta tread cautiously. You have to be very focused and intentional on what you're doing. So part of it is the underwriting, the conservative part of it, the business plan, beating it up more than you would normally do for these kind of cases and instances, and afterwards it's going to be a testy situation for the market, that's for sure. What else, Devin? What are your thoughts on it too?
Yeah, I mean, in some respects, I'm glad that we're here, because we kind of wondering what's going to be the next market correction. Well, now we know, and it's always something we didn't see coming, right? In 2000, it was tech bubble. 2008, it was mortgage-backed securities. 2020, it's coronavirus. Like, it's always something. We always bounce back. Right now, like as we're doing this webinar right now, the next couple of weeks are gonna be choppy, right? But everybody wants to do deals. Sellers want to sell, buyers want to buy, brokers want to do deals, banks want to lend. Everybody wants to transact. It's just right now, as we're doing this webinar, well, things are a little crazy, but we expect it to settle down. And now, I don't have a crystal ball, right? But at some point, with all this stimulus stuff, it's going to normalize, and it's probably going to create some opportunity. So the right this second, do we buy a deal tomorrow? We might have to wait a few weeks. That said, we're taking one of our deals out to sell here in a couple of weeks. And we talked to the broker today, like, yeah, we're gonna go sell it. Debt's cheap, and so we can go do that.
Yep. I think we missed one. Benny R. So Benny, starting out in multifamily real estate investing, I want to get into the game. What are some of the groundwork or jobs or details that I can do to provide substance for mentorship?
Yeah, I mean, this is a question that comes out a lot. The challenge is for somebody that's already up and running and going full speed ahead to stop and kind of show you everything. That can be difficult. That's why we created the Apartment Educators whole system, right? To teach you through everything, take you out on property tours, and do that. So that's why we created that Apartment Educators mentorship, because the kind of trade, if you don't have any skills, it's hard to step into somebody's existing business and work for free. It's tough, right? So that's why we created the Apartment Educators whole coaching program, to create a system around it that can get people up to speed so that they can do it. How long do you usually hold? 3 to 5 years is a very common industry standard, and I could totally dive into a lot of information on that. What I'm looking for as an operator is, what's the net return to investors? I might say 5 years. If we get out in 2 years and I can beat the projections on an annualized return basis, we might consider it. There's other factors, what's going on with your loan, what's going on with the market, this and that. Usually the first year is kind of when you're spending all your money to improve the property. So that first 18 months or so is kind of like, you're probably not going to sell it. After that, you might entertain a sale, but you like to set the precedence with investors that, hey, this is a 5-year hold. If that's too long for you, don't invest in it. We may get out sooner, but maybe up to 5 years. Opportunity zones, I'll just jump on that one real quick. Short answer for me, investing opportunity zones, no. This is a great government program, but essentially you've got the value of the dirt and the value of the building, right? So if the dirt's worth $3 million and the building's worth $3 million, take the dirt out of it. You buy the whole thing for $6 million, right? $6 million purchase. Dirt's worth $3 million, the building's worth $3 million. You've got to put $3 million of improvements into that, which is massive, right? So Short answer is no. Now, I am involved in some opportunity zone stuff that is a separate deal, but as a general rule of thumb, no, because you almost have to build something new or spend a ridiculous amount of money on renovations. You know, we're selling a property right now that's opportunity zone, but there's no way you could spend $3 million on that property, except maybe build new buildings, but there's no room. So short answer on opportunity zones, no. Question, Devin, how did you get started? What were your first steps? I bought a rental house. Actually, first step, I joined a mentorship group, right? I paid to have somebody do that shortcut for me. And I learned how to buy a house. I got a loan, renovated it, put a tenant in it, refinanced it, pulled out all my money. And now I'm a piece of investment real estate with some equity and cash flow. I was like, holy smokes, that's amazing. And then I spent too many years doing that. I did hundreds of those. And then, you know, after getting tired of banging my head against the wall, I was like, I've got to do bigger buildings. And the last building we bought was, you know, $26 million, right? And so those dots were connected in a couple of years, from buying a rental house for $40,000 to last year buying $26 million deal, you know, and that's the kind of power of this business model. Great question. So that's a lot of Q&A. I think we're kind of at time. Abel, is there anything kind of final thoughts you wanna part with here before we wrap it up?
No, I heard good feedback. Thanks, Zach. Awesome stuff. Thanks, guys. Looking forward to next month. So maybe that's a good segue. So next month's meeting, April the 21st at 6:30. Now that we are, you know, internet live streaming, please, you know, invite others, invite your friends, invite other, you know, people that are interested in getting more of the education. I think that's great. It's a great way for us to scale. And then I think at some point when we get back to some, you know, some situation of normal across the world, then the goal is to have our local meetup networking group, and at the same time broadcast those so that way people that are remote can stay with us and then join. So I think that's a great, you know, part of the new world moving forward, is for some innovation, for some, you know, technology advancement, right, of the community. So I think that's great. Keep up with it, and I think that's good. If anybody has any questions or follow-up questions, you've got apartmenteducators.com, you know, for training. You have Devin Elder, DJE Texas. He's got a bunch of podcasts, YouTube videos out there. You can reach me at 5tcre.com, 5talentscommercialrealestate.com. And you know, what else, Devin, anything?
I think that's it. I mean, I think it's a ton of content for tonight. We look forward to syncing up with you guys next month. And thank you all for joining. We really appreciate it.
All right. Thanks, guys.
All right, guys. Take care.